Okay, here's some information on the SoFiE Seminar Series with a website for upcoming seminars and email address to sign up. And then before we start, I wanted to do a quick reminder of a SoFiE virtual conference that's happening in early March, March 5. It's on machine learning and financial econometrics. The submission deadline is later this week. It's January 31, and full details are at the link at the bottom of this slide. Okay, well, welcome everybody to the second SoFiE Seminar of 2021. I'm Andrew Patton, the host of the series, and today I'm very happy to have Nicola Fusari from Johns Hopkins Business School as our speaker, and Elise Gourier from ESSEC Business School in Paris as his discussant. We're going to follow the usual format: 40 minutes for the speaker, 10 minutes for the discussant, and 10 for questions and answers from the audience at the end. If you want to ask a question during the seminar, you can do so either by doing the raise your hand button at the bottom of your Zoom screen, or you can type it in the Q&A box. And if you type it in, if you'd rather I ask the question, you can note that in your question. Otherwise, I'll assume you will prefer to ask it, and I'll call on you to ask it yourself. That's all of the background for the series. So Nicola, I'll turn it over to you and we can begin.
Let me share my screen. That should do it. Can you see it?
Great.
Okay, perfect. So thank you everyone for showing up on a Monday, and thanks the organizer and Andrew for the opportunity to present the paper today. So the paper is called Structural Stochastic Volatility, and it's a joint work with Federico Bandi, with Hopkins with me, and Roberto Renaud from the University of Verona. There we go. So, given that we only have 40 minutes, let me just jump right into the paper itself. So, the paper is about thinking about reduced form models for the asset prices, which are ubiquitous in finance and in the financial econometric literature. And if you think about this reduced form model, like for example in this case, XT can be thought as the price of an asset, of a stock. They all have three basic ingredients that usually we try to model in different ways. And these ingredients are stochastic spot volatility, sigma t in blue here. Then we have volatility of volatility, which is beta t. And then we have the leverage effect, which is the often negative correlation between log returns and shocks in the variance process. Here it's called rho t in light green, right? And so if you think about the last 20, 30 years of the financial econometric literature, the estimation of these three quantities that in the paper we call equity characteristics has kind of like generated three independent strands of literature. Each one of these strand of literature is looking particularly at the estimation of one particular equity characteristics. And the basic approach is usually to rely on high frequency time series data, right? So we started with realized volatility and then all the advancement from there. Now in the paper today, we try to kind of shift the way in which we think of this quantity. And you can think of, instead of relying on high frequency data or time series data, we try to use cross-sectional data. And what do we mean by cross-section for the sake of this paper is think of XT being an underlying asset, can be the price of IBM. Cross-sectional data for us is going to be a set of derivative products. In our case, it's going to be options with different strikes or different moneyness. Okay, so the different moneyness at a given point in time is going to give us a cross-section of derivative that we're going to try to use to jointly estimate these three equity characteristics. Okay? So throughout the paper and throughout the presentation, I'm going to try to show you that option can lead to accurate statistical estimates for these characteristics, and also estimate which are economically reasonable. And what do I mean by that is that we want to do or to go one step further. So instead of stopping at the reduced form model, one can interpret in the eyes of the original intuition of Merton in the 70s, we can see the equity or the stock price being a call option on the asset of the firm, but where the level of the debt is the strike price of that option, right? So if you start thinking in that way, then the dynamic of the equity and the dynamics of the equity characteristics is nothing else than a function is a function of the structural quantity of the firm. So it's going to, so basically spot volatility, spot leverage, and spot volatility, they're gonna inherit the dynamics coming from the asset of the firms and possibly the volatility of the asset of the firm. So there is a mapping there between the structural quantities and these reduced form equity characteristics, and that's what we're going to try to uncover in the data. And so we're going to try to show that once we estimate these equity characteristics from options, we are able to uncover three main results. One is there is a strong positive relationship between spot volatility and financial leverage. Financial leverage here, think of the asset of the firm AT here, just rescaled by DT. That's basically what we usually call financial leverage, right? So spot volatility, financial leverage, positively related. That's nothing completely new, but sometimes is overlooked. Something that I guess people have been looking at and has been difficult to bring to light is actually a negative relationship between spot leverage and financial leverage. At the end of the day, we call that correlation leverage effect because in the back of our head, we have the fact that there should be a relationship between financial leverage and the leverage effect. But when you try to measure that in the data, it's always been very difficult to pin down that relationship. And what we are trying to argue today is that it's really because it's very difficult to estimate the correlation coefficient, but options can be very valuable in give you an estimate of that. And then the third results, which possibly new to our knowledge, is that there is a positive relationship between volatility and financial leverage, right? Importantly, I'm going to try to show you that these same relationships are very, very difficult to see if you rely on estimates of the three equity characteristics based on high frequency data. Okay? So let me give you a preview of the paper with a diagram, and I think maybe it's going to help us. It's going to help put some results in context. So we're going to start by looking at equity options, and we do so because these are derivative contracts that are becoming increasingly liquid and popular, not only on indexes but also on single name stocks. Right? So I'm going to show you that within a structural model of the firm, there is a clear link between options and the characteristic of the equity. So spot volatility, and leverage effect. Right? And so we're going to try to use option to estimate these equity characteristics, and then we're going to try to link them with the firm's fundamental. And this link is given by following the Merton intuition by this call option, where equity can be seen as a call option on firm's fundamental. Okay, so the first part of the paper is going to be focusing on the link between firm's fundamental and asset prices. And then in the last part of the paper, we're going to try to close the circle and look at the integration between the equity option market and the corporate bond and CDS market. And if you think again through the lenses of the the structural model, both options and corporate bond and CDS, they're going to load on the same firm's fundamental: leverage, financial leverage, and asset variance, right? And so we could expect that quantity that we extract from the option market, the equity characteristics, right, should be able to explain the variation both in the cross-section and in the time series of CDS spreads, for example. This is what we find at the end of the paper. Okay? So how do we estimate the following time varies quantity? Again, we argue that it's reasonable to we kind of know that spot volatility can be estimated rather precisely using high frequency data. It's less so obvious that volatility and the leverage effect can be estimated precisely using the frequency data, especially at the frequency at which we observe prices for our empirical application, which is within like every 5 or 10 minutes. It's very difficult to get precise estimates of vol and leverage. And the reason for this is because both the estimator of vol and leverage they require an estimate of the equity volatility as a first step, right? And so any estimation error that you do in that first step is going to influence then the second step estimation of vol and leverage, right? So using option, we kind of avoid completely this two-step procedure, and we can estimate these three quantity jointly. Now, let me step back 1 second because I think I haven't mentioned something important. You might think that given that we are using options, these quantities, they're going to be polluted by risk premium, right? Because I'm working under risk neutral distribution. But this is not the case because we're going to be looking just at spot quantities of these equity characteristics, which are invariant to change of measure. So spot volatility, spot leverage, and spot vol, they don't change when we go from the statistical measure to the risk neutral one. So I can estimate those three characteristics either using time series data or using cross-sectional data as we are doing in this paper. So why do we use option? This is a point that I made in a previous paper with Victor and Torben. In that paper, we were looking at SPX options. Here we are looking at single name options. And here what I'm plotting is the monthly number of options available on average with less than 12 days to maturities. Okay? And you see that over the last 10 years, we have so many more options available with short tenor, and this basically allows us to, look at way to price those short maturity option and way to extract information from short maturity option. And I guess I will argue that pricing short options is a potentially easier job than pricing long maturity option, because there you need to really model the dynamics of many quantities, jump intensity, stochastic volatility, how these two relates to one another. While if you just shrink the time to maturity to 0, you can assume many of these quantity to basically stay fixed. Okay. So what do we do? Let's step back and look at our reduced form stochastic volatility model. I know you don't see jumps in return here. Don't worry, I'm going to put them back later on, just I want to keep the presentation clean as of now, so I don't put them there. So consider XT being the price of an asset, and here the usual suspect, we have stochastic volatility, sigma t, vol, and the leverage effect. Right? Now, I'm gonna use the results in a working paper of Federico and Roberto, where they basically been able, through a local ledger expansion, to find a way to approximate the characteristic function of the log returns, okay, under this very general stochastic volatility model. Right? So this expansion is going to have three terms. You're going to have the characteristic function of the Gaussian here. Then you're going to have an expansion of the first order, which is square root of delta. Delta here, think of it as the maturity of the option. Okay? And you see that at the first order, you have these three objects entering, right? You have beta and rho at the numerator, and you have spot volatility at the denominator. If you go to the second order of the expansion, which is of the order of delta here and here, this approximation actually allows you to separately identify the two parameters here, rho and beta 0, which is the vol of vol, right? And the last one is also alpha 0, which, if you go back here, is basically the drift of the volatility process. Okay, so if you use the second order expansion, we can potentially identify all of these parameters. We treat these as parameters. As I said, we are going to add to the pricing formula jumps in returns. They're going to be like standard Gaussian distributed jumps, and we also add jumps due to earning announcements. Since we are dealing with single name options, we know that the stochastic volatility, the implied volatility of single names tend to explode when you get closer to announcement day. So we kind of need to control for that if you want to get clean estimates of the equity characteristics. Okay. Now, can we identify these three objects, sigma, beta, and rho t? And we emphasize here, again, we are working under the risk neutral measure, but these quantities are invariant to change of measure. So looking at options, we are able to extract quantity that are also common to this physical measure. So we argue that we can actually identify this quantity, because if you look at how they affect the implied volatility surface, which is ultimately the data that we are going to be using to extract those quantities, that implied volatility is affected by changes in those parameters in a different way, right? So here we plot the derivative of the implied volatility surface with respect to the three different parameters: spot volatility, spot leverage, and vol of vol, right? So whenever you see value far from zero, means that the derivative is very different from zero, means that we have potential for identifying those parameters from those set of options. And so, not surprisingly, you see that spot volatility is really identified by options which are around at the money, which is basically the vertical line here. The spot leverage, this is not a new result in the literature. I think the few works have highlighted this. One that comes to mind is Mendeleev and Scaillet in the JF paper. But the spot leverage is going to be identified by the slope of the implied volatility near at the money here. And then this spot volatility has more to do with the concavity of the implied volatility surface, and is going to be identified by this around out of the money option, but not really too out of the money. Right? So I'm going to do first, I'm going to show you through some Monte Carlo simulation that you can estimate those quantities from options, and then I'm going to bring this approximation to the empirical data. Okay, so in our Monte Carlo simulation, we take a very standard model used in the literature. This is the double jump model. Introduced by Duffy, Pan, and Singleton in the Econometrica paper, then used by Endel's paper. I guess Brody, Charon, Johannes is among the first one. So we have the dynamic of the equity of a firm. Is going to have stochastic volatility, is going to have jumps in return, is going to have jumps in volatility, and these two jumps are actually correlated. Right? So in the simulation setting, we allow, even if our approximation doesn't allow for jumps in volatility, we do put jumps in volatility into the simulated model here, right? So we take the parameters from the BCJ paper. We just need to do a couple of adjustments.
Nicola, could I interrupt for a moment?
Yes.
Just before you get into the simulation, we have a question from the audience which relates to the jump specification. So I thought maybe this is a good time to take it. Is that okay?
Yes.
Okay.
Yeah.
Let me. It's a long question, and he can ask it better than I can. So this is from Gustavo Schwenkler. So let me get him to ask it instead.
Hey, Nicola, how's it going?
Hi, Gustavo. Hey.
So it's funny that you were just talking about the jumps, because I had literally just texted my question, because I was thinking that exactly what does this really imply? Because in a way, my interpretation is that if you don't include the jumps in your model that you're ultimately estimating, then the volatility that you're estimating includes both kind of the true underlying jump dynamics and the volatility dynamics. And while it's true that the volatility doesn't get affected by the change of measure, the jumps dynamic do get affected by the change of measure. So I have a sense that you might still be capturing risk premium effect related to kind of those jumps that you're not capturing, even though like you're assuming that there are no jumps. Have you thought about whether it's possible to kind of include jumps in your model, or is that just kind of not possible?
Okay, so let me give you a couple of answers. So the first is we do include jumps, but we only have jumps in returns in our approximation. So here, when you go to our approximation here, we are going to be adding jumps in return here. So we're going to have like just normally distributed jumps. What we cannot add at this point are jumps in volatility. That's something that we are working on, and Federico and Roberto especially working on this, but it's more challenging things. Now, what you can see from this sensitivity analysis is that really, when you start going really out of the money, the movement of the implied volatility when you go very out of the money doesn't really impact these three characteristics, right? So what's going to happen when I simulate from a model that has jumps in volatility, for example, and these jumps can be correlated with the jumps in return, is that I then go and estimate my jump parameter. Those jump parameters are going to try to compensate for the presence of jump in volatility. So they're going to be biased upwards, if you know, so to speak. So the equity characteristics which are mostly affecting there is neutral distribution around at the money. They are potentially they could be affected depending on the value of the parameters, but they're not that affected. And I'm trying to show that in the simulation. While what's going to happen is that the jump parameter, they're going to possibly be biased because they are going to compensate for the lack of jumps in volatility.
Yeah, but I was thinking mostly, like, I think statistically speaking, yeah, that there might be biases, but I was thinking mostly economically speaking, are these kind of estimates that you're estimating really estimates under the P distribution or partially under the risk neutral distribution, right?
I mean, in theory, I guess if the maturity of the option is really short, I think that we could do a good job. But I guess that there could be some contamination, but I think it would be very small. Okay. But let me show you the simulation results, and we can circle back there. Okay.
Sure.
Okay. So again, going back, I'm going to simulate from a model that has jumps in return and has jumps in volatility, and we allow for those jumps to be correlating with each other, right? So I take the parameter of BCJ, and we need to do a couple of adjustments because in that model, the leverage effect is fixed, it's just a number, and the vol is just a number, right? But here we want to allow for time variation in those. So I'm going to assume that the leverage coefficient follows an AR1 process with a 1 year half-life, starting at minus 0.45, which is the point estimate of BCJ. And I do the same for the vol AR1 process, starting at 0.2. And then how do I set up my simulation? I just simulate a long trajectory that spans 10 years. This is very similar basically to what we are going to be doing in the empirical section where we have 10 years of data. We generate prices every 5 minutes. This is again mimicking what we do in the empirical study. At the end of each day, okay, I'm going to price 11 options on an equally spaced grid, where the moneyness goes from -4 standard deviation to the negative side, and to +2 standard deviation on the call side. And then I'm going to also allow for possible observation error in the implied volatility. This is coming from recent work that I've done with Torben, Victor, and Rasmus. So we will kind of take account of possible beta spread, observation error, and so on and so forth. Then what do? So we estimate on each day the parameter of our approximation. And how do we do this? We just optimize over the difference between the implied volatility of the model. This is the BCJ model, right? This is the double jump model. So this is the implied vol generated by this auxiliary model that we use, minus the implied volatility that comes from our local approximation, right? So here I have all my 3 equity characteristics, rho, beta, and sigma t, plus I also have the jump parameters, like the mean of the jumps, volatility of the jumps, and sorry, here I forgot, but there is also the jump intensity. Okay? We also complement this objective function with a penalization, which is given by the difference between sigma t, which is the object that we are optimizing over, and a measure of spot volatility that you can obtain from high frequency data. Again, given that spot vol is unaffected by the change of measure, if this guy is estimated correctly, should be quite close to the high frequency estimate. Now, we do this especially for adding robustness to the empirical section. This volatility penalization is not really needed within our model. It's more like, think of it more as a robustness. Also, it's going to help us in pinning down the value of alpha t, which is this mean reversion. Okay? So we do this estimation of these parameters day by day over a month, and then I'm going to take the average over the month, right? Because the single day estimate can be a little bit noisy. So I'm going to try to reduce the estimation error by taking the average over the month. Now, we are going to be doing the same thing now, or a very similar thing on the high frequency side, because since we simulate our model every 5 minutes, right? I can estimate the daily measure of realized volatility or the continuous component of the realized volatility. We use the threshold by power variation of Corsi, Pirino, Renault. And then basically we do daily estimates and we average over the month to reduce the estimation error. So we are going to have high frequency estimate of spot vol over the month. Again, remember, this is the monthly average, vol of vol, and leverage effect, right? So what's going to happen in this simulation? So here you see 3 panels, and in each panel you have 3 lines. One is the solid dark line, which is the true simulated process, right? So on the left side, you have spot volatility. Then we have the leverage coefficient here, and we have volatility. Now, the other 2 lines are, is the light dotted line, and those are the estimates that you obtain using just a plain vanilla, the one that I show you, high frequency estimators, right? And the darker dashed line with the little stars are the estimates that you get from the options data. Now, you see that spot volatility, it's pretty easy to pin down. You can either use high frequency data, you can use options data, you are always spot on, right? When you go to the leverage coefficient and vol of vol, things are very, very different. The leverage coefficient tends to be drawn towards 0, and there is very little persistence there. It's very noisy. And the vol of vol, even if it seems that there is some persistence here, but if you go back and look at this, at the trajectory of the volatility, what the vol of vol estimator is doing is basically mimicking this guy, right? You see this big spike around 100 month is exactly the big spike that you see here. So using the high frequency data, you're not really able to pin down or like to estimate the unique variation of the vol of vol, but you're kind of mimicking the variation of the spot volatility. Now, to show you that, as I said before, we think that the reason for this behavior is just because the high frequency estimator, they require a first stage estimator of the spot volatility, right? And so that's noise, the estimation error in the spot volatility in the first stage is gonna create this noise in the estimation part. So what do? I basically here I plot the infeasible estimator of the high frequency estimators, where I replace the spot volatility in the first stage with the true volatility, right? So I'm going to just use the true simulated volatility process. And this is the line that you see with the little circles, right? Now, you see, simply replacing the spot estimator with the true one, like brings you the leverage effect. Basically, you are exactly spot on. And even for volatility, the high frequency estimator becomes spot on. The only spikes that you see here, those are basically the jumps in volatility that they are present in the model. So then you're gonna find those little jumps there. So it really is this first stage estimator of spot volatility that really complicates the life when you try to estimate this quantity using the high frequency data. All right, so up to now, I think I convinced you that options can be revealing for the dynamics of these equity characteristics. Now, as I previewed at the beginning of the talk, I just want to go a little bit deeper and try to link the dynamics of these equity characteristics to firms' fundamentals. Right? So I'm going to introduce a very simple, call it structural model. Now, remember here, the goal of the paper is not to come up with a very fancy structural model. We just want to show that there is a relationship between the structural quantities and the reduced form quantities. Okay, so this is a very basic, so to speak, structural model. It starts with in the spirit of Merton, we're going to have the dynamic of the asset of the company. The asset of the company, they're going to have stochastic volatility. This is the usual Aston model, and we allow the asset to jump. Okay, and there is going to be correlation between shocks in volatility and shocks in the asset. Right? Now, in the eyes of Merton, you can always now see the equity, right, the price of a stock, as being a call option on the asset of the firm. Right? And so you just do Ito's lemma, and you can write down the dynamic of the equities, and you can also write down the dynamic of the volatility of the equity. Right? Just plain vanilla application of Ito's formula. And what's going to happen is that at the end of the day, we are able to rewrite sigma t, beta t, and rho t, basically the characteristics of the asset price as functions of the structural model, right? So here we have the volatility of the asset, for example, right? Here we have this E of V, this is the vega of the options. Remember, equity is just a call option, so all the Greeks, Delta, Vega, Gamma, Vanna, and Volga are going to enter the specification of our spot quantities. Again, you remember, we are looking at equity of the company as a call option on the asset price, so that all the Greek of that call options, they're going to affect the dynamics of the equity characteristics, right? And now within this model, you can just look at these characteristics and see how they change as we move the main state variable, which are asset price, the price of the asset, and volatility of the asset. And this is what I do in this plot here. So in the top panel, I just show basically the relationship between the equity characteristics, volatility, again, leverage effect, and vol-of-vol, as a function of financial leverage. Remember, financial leverage is nothing else than the asset of the company, AT, divided by the debt, right? And now here we really see a clear relationship between these characteristics and financial leverage. Specifically, as financial leverage becomes larger, right, volatility shoots up. That's something that we teach to our students, I think. This middle panel, I think it's less known. So within the model, there is a clear negative relationship between financial leverage and the leverage effect, right? As the firms gets more debt, the leverage effects becomes more negative or higher in absolute value. And also, when you look at volatility, as your leverage goes up, volatility tends to shoot up, right? And now in the three bottom panel, instead of looking at financial leverage, which is one of the two state variable in the structural model, I'm going to change the asset volatility, right? So here I'm changing AT. Here I'm going to change V of A, right? The volatility of the asset. And you have very intuitive relationship there. Now, for the rest of the paper, we're going to try to exploit the top three panels, right? Just because it's relatively easier to measure financial leverage, I can just look at CompuStat data. It's a little bit harder to study the bottom three panels because we don't have very good ways to estimate volatility of the asset, even if maybe something could be done there, right? So what I want to do next is I want to bring our machinery to real data, try to estimate the equity characteristics, and then try to see whether we can uncover relationships similar to what we see in the structural model. So do the data support this basic relationship that we see in the structural model between equity characteristics and financial leverage? Okay, so we move to the data. We look at the component of the S&P 500 from 2006 to 2014, and we apply standard filters. We only keep short maturity option. We go only up to 13 days. We only keep cross-section where we have at least 5 different strike prices, and we remove some outlier. At the end of the day, we end up with a set of 130 firms for which we feel pretty confident that we have reliable data. So we really throw away a lot of stuff because we were looking for some robustness in the estimation. And here basically is just a summary of the estimates. So remember, what we do is we take these 130 firms, we take option on those. On every day for each firm, I estimate rho, beta, and sigma t along with the jump parameters. I do that every day for each firms. Then within each month, I just take the average for each firms. And here I'm basically plotting the results, right? So the dark line here is the median estimates, and then you have the 25th and 75th quantile. So at each point in time, here you see the dispersion of the 3 equity characteristics across firms, right? And you see that as the structural model suggests, there is a clear commonality in the dynamics of the 3 quantities. Again, this is not surprising because when you go back to the structural model, these 3 quantities, they share basically many of the Greeks, many of the way in which this equity characteristic loads on the underlying asset of the firm are the same. Okay? So it's not surprising to see that when spot volatility goes up, spot leverage drops down, and volatility shoots up again. Okay. So then I just start looking at these estimates in an unconditional way. So I take my time series estimate for each company, and I just take the time series average. So for each company now, I'm going to have the average value of spot volatility, average value of leverage effect, average value of vol, and I just do a scatter plot of that, these quantities, sigma, rho, and beta, over the average value of the financial leverage for that company, right? So this is the unconditional analysis. And you see that company with high volatility, average value of volatility, tend to have higher financial leverage. And we do find, and this is a result that I think it's, in the literature this part of the literature has been trying to look at this for quite some time. We do find a clear negative relationship between leverage coefficient and financial leverage. And we find a positive relationship between vol and financial leverage. And then we also, you're going to see this in this plot, you're going to see this in the slides. In the table, we put together beta and rho as the product, because that's the quantity that can be identified if we stop the approximation at the first order. If you remember the first order approximation here, we could identify beta and rho as a product. So that's why we report the results also for that quantity. So this is just a visual inspection. A little bit more formally, we just run regression here. So here we just basically run the regression behind those scatter plots. We report only the t-stats here. So these numbers are all t-statistics, and then we report the R-square at the bottom. So here is basically each column is a different regression. Here is a regression of financial leverage over spot volatility, coefficient as the model implies, positive, R-square around 13%. If you do the regression only on financial leverage, only on spot leverage, negative, strong statistical significance, vol positive. Even when you start, putting together some of these equity characteristics, they might lose a little bit of significance, but the signs remain according to what economic intuition tells us. You can do the same result. You can do the same analysis now in the time series. So what do we do now? We regress financial leverage over each equity characteristics over time for each company. And then here I'm plotting, I'm showing you the average of the t-stats and the average of the R-square of all these 130 regression, right? And again, you find a positive, strongly significant t-stat for volatility, negative for leverage effect, positive for vol. Even if in the time series seems the volatility is taking over as you put these together. The one that remains strongly significant is spot volatility. Again, this is not surprising, because these three quantities, they do share a lot of common variation, because they depend on the same driver coming from the firm asset and volatility of the asset. Right? Now, can we do the same analysis if I just look at high frequency data? Now things are a little bit different. If I compare the option estimate with the high frequency estimates, this is what you see. And this is just one picture, but we have many more like this. So the dark line here is the estimator of the spot vol coming from option. The dotted line is the high frequency one, which they are relatively similar to each other. When you go to leverage effect and spot vol, the high frequency estimator, they're really struggling. Here in the spot leverage, there's very little persistence. And the vol, as we found in the simulation study, is basically mimicking the volatility process. It's not really capturing unique variation of the spot vol. Same thing for Caterpillar, same thing for General Electric. I swear we didn't pick just these three because they're the only three nice ones. It's a very common pattern that you see.
Sorry, Nicola, just 2 minutes.
Yeah, okay. So if you try to do the same exercise I did with the options using a frequency data, what you do in the cross-section, you don't find anything. So there's no positive relationship between these equity characteristics and financial leverage. You do find something in the time series, just because spot volatility is estimated pretty well, even if you use high frequency data. So this is statistically significant. Vol is statistically significant, but the gain is just because he's mimicking this guy here. Right? So what do we do? The last step of the paper, I want to see whether I can use this equity characteristic to explain variation in CDS, just because both these guys, they are just function of the firm's fundamentals. So here, very quickly, I take 5-year CDS spread. I regress those on financial leverage. We know that's the main guy here playing. And then also on the 3 equity characteristics that we estimate. And we see that everything enters significant with the expected sign. So we kind of show that there is some sort of integration between the options market and CDS market. This is in the cross section. You can do the same thing in the time series. Last results, I swear. If you try to redo the same analysis using the equity characteristics estimated from high frequency data, you don't find anything here. All the R square are 0.48, which is the R square of the financial average. And in the time series, the only things it's spot volatility is significant. This is not a new result. I think Zhu and co-authors have an RFS paper in 2010 where they use a realized measure to improve CDS pricing. Okay, so this is it. So what we do in this paper is we exploit a local approximation to the characteristic function of the price process. We use this to price short-term option, and from this option we extract estimates of equity characteristics, rho t, beta t, and sigma t. We show that these equity characteristics, as shown by a simple model of the firm, are related to firm's fundamentals, and we provide some suggestive evidence of integration between the CDS and the option market. Done. Thank you very much.
Okay, thanks very much, Nicola. That was great, right on time. So now I'll turn it over to Elise. Maybe Nicola, you might have to stop sharing your screen.
Right. I'll always forget that. Oh.
All right. Can you see my screen?
Yes.
Okay, great. So thank you very much, Andrew, for letting me discuss this paper. I enjoyed reading it a lot. So let me quickly recap what the paper does. The main goal is to estimate the time series of realized spot volatility, volatility of volatility, and spot leverage for individual firms, and to see how these relate to the financial leverage of these firms. It's a very ambitious task because it relies on estimating quantities that are typically extremely difficult to estimate. There's a large literature on the estimation of the spot volatility. It's usually done either using a reduced form model. Most of the time it's an affine model, but then the volatility of volatility and the leverage effect are just constants. Or it's done by using high frequency estimates. But with high frequency estimates, the problem is that the estimate of the vol and of the leverage effect both depend on the estimate of the volatility. So a little bit of noise in the estimation of the volatility is going to propagate and result in very noisy estimates of the vol and of the leverage effect. How do the authors do it here? Well, they use a reduced form model, but they do not impose that it's affine. They have an extremely general specification of the dynamics of the stock. And to me, that's really the beauty of the paper. We know that whenever you get out of the affine framework of models, it becomes extremely difficult to price options. They manage to find a way around by focusing on short-term options. So basically, they use an approximation of the characteristic function of returns that's specifically designed for short-term to maturity. Based on this, they mentioned 4 contributions. The first one is to infer the time series of spot volatility, vol, and spot leverage for short-term options. So they have monthly time series. The second one is to use a structural model of the firm's assets to predict how these estimates are related to the firm's leverage. The third contribution is to test these predictions on real data of firms' financial leverage. And finally, the last one is to show that the time series of spot moments can help explain credit spreads. It's a very nice paper. It contains a lot of promising results. So I recommend to everyone to read it. All right. So now let me go through each big part of the paper and give some comments and questions on it. So first, option pricing. It's done using an Edgeworth expansion of the characteristic function of returns. The three quantities of interest, so the volatility, the vol-vol, and the leverage effect, they don't vary under change of measure. So Nicola insisted on that. However, the characteristic function also depends on some quantities, so in particular the volatility drift, which may be dependent on the measure. So I was wondering what assumptions exactly were made on the risk premium. My second point is on the Edgeworth expansion of the characteristic function. So my experience with Edgeworth expansions is that one needs to be extremely careful on how many orders to include to reach a price that's precise. And in particular, when you price out of the money options, which are fairly cheap, a small absolute error is going to translate in a potentially big relative error on the price. Depending on the model used, and in particular with non-affine models, one may need to go to high orders. So that's at the expense of computational time. Here, the expansion comes from a working paper of Federico and Roberto. And this paper takes the expansion as given, but I think it would be nice to have a bit more information about it, maybe at least in the appendix. Okay, second part of the paper, so that's identification and model tests. So what the authors do here is that they consider the affine model of Brody, Chernoff, and Johannes, so their model in their 2007 paper. They simulate from it, and they test whether they can recover the spot volatility, the vol-vol, and the leverage coefficient. So to me, the strength of the paper really is that it goes beyond affine models. With affine models, we know how to price options, so we don't need to focus on short-term options. The challenge is really when the model is not affine. So testing the method using an affine data generating process sort of defeats a little the purpose, especially when one of the goals is to estimate the spot leverage. It's a little odd to take a model which sets it equal to a constant. There's a growing literature showing that affine models are not appropriate to price options. I've done a little bit of work on that. In my paper, I find that the pricing of short-term VIX options is not very good. And that indicates in particular that the vol-vol is not very well represented. If you do a QQ plot, a simple QQ plot of daily changes in realized volatility, so basically an affine model would predict that these daily changes are normally distributed. Clearly, it's not the case. If you take instead a linear variance model, so that would be a model in which the volatility of the variance is linear in the variance instead of being linear in the square root of the variance. It will predict that changes in the log volatility be normally distributed. That's much more in line with the data, as you see on the second plot. So I think the model test would be much more convincing if the authors were simulating from a non-affine model. So for example, a linear variance model, or more generally, a constant elasticity of variance model. The authors show that with an affine model, options with varying moneyinesses allow identifying the three spot variables that they're trying to estimate. I don't think the results would change much with a non-affine model. What may change, however, is how far out of the money you need to have options in order to identify the vol-vol and the leverage effect. It's not clear that the data contains options which are far enough out of the money. So here the authors also show that even if the data is simulated from a model with jumps in the variance, despite the fact that they have no jumps in the variance in their own model, the three spot variables are well recovered. So is it still the case if you simulate from a non-affine model? What if you take a more general specification of the jumps? Would you still recover well the volatility, vol-vol, and the leverage time series? Furthermore, the model is tested on 1 day, so that's the first series of tests that are performed. So what the authors do is that they take values of the spot processes that are equal to their long-term means. They simulate paths from the data generating process. They simulate option prices, and based on the simulations, they recover the volatility, the vol-vol, and the leverage. Would they recover the three quantities as well if they took values which are far away from their long-term mean? Why do something which is just a static exercise instead of simulating from the model over a time series like they do later in the paper? So my last point here is that the authors give the point estimates of the recovered quantities, but they don't give the standard deviations, at least in the version of the paper I have. So it would be nice to see how far the predictions can be from the real time series. So the next part of the paper compares the recovered time series to the high frequency estimates. They slightly extend the Brody, Chernoff, and Johannes model, simulate from it, but now over a time series with 5-minute simulations. And they calculate estimates of the volatility, vol, and leverage with both methods. So here again, I want to question the appropriateness of the Brody, Chernoff, and Johannes model, even extended. It seems to me like that with high frequency data, you might want to use a non-affine model or maybe a model with a much more flexible structure of jumps. Using this model, the authors conclude that their estimates for the spot variables are much more precise than the high frequency estimates. In particular, the high frequency estimates of the vol and leverage are biased, but I think the comparison is a little unfair. In a recent paper that's cited here, Italia and co-authors proposed several estimators of the vol and the leverage effect, and some of these estimators include a bias correction. The paper is used here, but the authors do not use a bias correction. So I'm wondering if the high frequency estimates would be as bad as they are here in the paper if you use the correction. Okay. So in the next part, the paper uses a structural model to make predictions on the relation between the spot variables and the financial leverage of the firm. They make 3 predictions. So the spot volatility and the vol increase with financial leverage, and the spot leverage decrease with financial leverage. This part of the paper is very close to 2 published papers, which are not cited here. A 2016 paper by Geske and co-authors, and a 2018 paper by Engel and Siriwardane. The first paper focuses on prediction number 1, the relation between the spot volatility and financial leverage. The second paper uses a very general model and obtains predictions on the spot volatility and the spot leverage. They mention the vol, but they don't focus on it. I would recommend to build on these papers and to position yourself more clearly with respect to them. In particular, the link between the stochastic differential equation of the equity process and the SDE of the asset process could be made a little clearer in the context of non-affine models, at least non-affine equity models. Once the predictions have been formulated, the authors proceed to implementing their approach to check them in the data. So in this slide, I just want to review very quickly what the literature finds on these predictions. The Engel and Siriwardane paper finds evidence in favor of the first prediction. But Adrian and Shin in a 2010 paper highlight the fact that it may not be true for all firms. The structural model of Merton, so this is a model that Nicola and his co-authors build on, it assumes a passive capital structure variation. So what Adrian and Shin argue is that many firms are actually proactively varying their capital structure. They cite 2 examples. Commercial banks are proactively adjusting their debt to equity ratio in order to comply with regulations, and investment banks, which are going 1 step further and are actually leveraging in times of booms and deleveraging in times of recession. So this kind of behavior goes against the predictions of the model here. Finally, the paper by Hassan Houtfish and Lowe, which is cited in their paper, finds that all equity finance firms have a negative leverage that is as strong as firms with financial leverage. So what do they find in this paper? Let's first look at the data. In terms of data, the authors use a time series of options, which goes from 2006 to 2015. But note that until 2013, there's only about 2.5 options per day. So this is pretty far from having a range of options which span wide moneyness. They include all firms in their analysis, which they end up with 130 firms. But because of the Adrian and Shin paper, I think that because financial firms have been shown to proactively change their capital structure, maybe it would be interesting to repeat the simulation excluding financial firms. The authors obtained time series of spot volatility, vol, and leverage for the 130 firms that they consider, but they only present the median time series across all firms, as well as interquartile ranges. I would like to see a more detailed analysis of this time series. How strong a factor structure does it present? Can you say anything about the idiosyncratic variation? Can you reject the hypothesis of an affine model? Is it really worth going to such a general model formulation? All right, I'm almost done. To test the 3 model predictions on the relation between the spot variables and the financial leverage, the authors used scatter plots and linear regressions, but they showed very clearly before that the model didn't predict linear relations. So why not instead use portfolio sorts? You could sort firms by their financial leverage and then see within each bucket, within each percentile of firms, what is their median volatility, vol, and leverage. This could highlight relations which are different across time for different economic conditions, and it would also accommodate non-linearities. My last point is on the 3 spot quantities explaining credit spreads. So the authors show that they have some explanatory power on top of financial leverage to explain credit spreads of CDS. The literature has shown that credit spreads are explained not only by default risk, but also by liquidity risk, and more broadly speaking, by market frictions. There's a parallel literature on the link between option prices and these market frictions. So it would be interesting, I think, to understand whether the 3 spot quantities help explain credit spread because they contain information on default risk that is not contained in financial leverage, or because they contain information on liquidity risk and market frictions that is not included in financial leverage. So that's about it for my comments and questions. It's a very nice paper. A lot of things can still be done, I think. And I look forward to seeing future versions of the paper. Thank you.
Okay, well, thanks very much, Elise. That was great. I know for those watching the clock, I let that run a little long because this was a referee report.
Sorry about that. I went over time. Yeah, I didn't.
No, this is great. So I think maybe what we'll do, Nicola, if you would like to respond to any or all of these, please go ahead. And then we'll do questions from the audience in the Hangout session after the official.
Yeah, well, thank you, Elise. As Andrew said, it's really, there's so many points that they're for sure they're going to make their way through to a revision of the paper. So I think your first comment was about alpha T, which is the speed of mean reversion of the drift in the volatility process. I think that you raise a good point, saying that quantity is actually not invariant to change of measure. And I think that the way in which we see that is that by using short maturity option, we can kind of think that, mean reversion kind of be, second order effect in the volatility process. So possibly doesn't do too much harm there, which
so
is
this would include also actually what Gustavo talked about before. It's not just alpha T, it's all the terms basically in the characteristic function, which are possibly variant under change of measure.
Yeah, so that's a matter of like, if we are short enough, we should be okay, unless there is some very strange dynamics, which is your second point. So the reason why we chose to go with the affine specification of the BCJ model is just to do something that people usually do and they can relate. We just want to look at the precision of the estimator, but definitely in a revision, either in appendix or replacing these, we can definitely try to go full blown non-affine model and see how we fare there. For the high frequency estimators, we did try to play around with different estimators. Probably we did not do a fair enough of a job, but our sense is that sticking at the frequency at which we have in the empirical application, which is 5 minutes, is going to be a very, very difficult task for the existing estimator. Like existing estimator, if you start going at the second, millisecond, then you get very precise results. But at with very few observations per day, I mean, we can definitely try, but we just wanted to show like the plain vanilla results there, but we can definitely do more. Thank you for the reference to the angles you were done a paper. We had that on our list. Probably we don't do a fair job in referencing that. Capital structure, you raise a good point, and that's actually good because if you look at our scatter plots, the few outliers are all financial. JP Morgan is always floating around, so that's a good way of spinning that. We do a sector by sector analysis in the appendix, but of course then you start slicing a little bit too much. You have 10 observations, but we can definitely take financial out. The reason why we stopped in 2015 is that because we want to do the CDS analysis, and our data on CDS stopped at 2015, the market data. So that's why we stopped there, but definitely maybe at some point we should think of expanding the window. And I think that's the main points I got, but I'll make sure to go over every single point that you raised. I think it was a great discussion. Thank you.
All right. Well, thanks very much for that response, Nicola. I think what we'll do here is to move questions to the session after we stop the recording. So before we stop the recording, let me do a brief advertisement for the next SoFiE seminar. So the next SoFiE seminar will be in 2 weeks' time. The speaker will be Claudia Moyes from Fuqua Business School here at Duke, and her discussant will be Joel Hasbrook from NYU Stern. That's on February 8th. So 2 weeks from today. I hope to see many of you then. And for any Australians who are in the audience, happy Australia Day for tomorrow, today in Australia time. And we'll leave it there. See you all in 2 weeks.